It is time now on Morning Focus for our financial advice slot. I'm joined as ever by Tommy Corbett from Kerry Corbett Financial Solutions. Tommy, how are things?
Morning, Alan. Good.
Morning to you. Last time you were with us, of course, you took us through the markets and an appropriate enough topic for this week, market volatility, and why you shouldn't make rash decisions with volatility in the markets, because there's a certain someone who, depending on what he does or doesn't do, or does or doesn't say, or doesn't think,
Or tweet.
Yeah. they can change drastically. So a very apt topic to talk about.
Yeah, it's something I suppose we're coming across quite a bit now, maybe with clients in relation to queries in relation to whether they should cash out, or, and maybe certain clients maybe a little bit anxious in relation to their investments and pensions and that kind of thing. And I think we've always stated here, Alan, that investments or pensions are a long-term savings vehicle, and it's very important that you don't panic in times of volatility, because I suppose I came across a line actually there last week. I thought it was quite good. It's basically market volatility is the price of admission for long-term investment growth. So you have to put up with it basically and not panic. And panic does set in at times, and basically you need to ride out the storms basically.
Yeah, you're always urging people who have investments to take a long-term approach and not be irked or scared or spooked by events in the here and now. Because believe it or not, better times do lie ahead at some point.
They do, yeah. And even if again, it's something I think I might have mentioned here, even if you look at the last 10 years, if I said to you, Alan, and you had 10,000 to invest 10 years ago in 2016, I said, well, what's going to happen now in the next 10 years is we're going to have Donald Trump who's going to be elected and cause havoc for 4 years. Not to mind the second time, we're going to have Britain leaving Europe. We're going to have a pandemic that's going to last for 2 or 3 years. We're going to have huge interest rate hikes. We're going to have huge inflation. We're going to have war in Europe. Yeah. We're going to have war in the Middle East. She wouldn't have given anything. You know what I mean? You wouldn't have invested, and yet you're in a normal 60-40 portfolio, you would probably have doubled your money, so that is I suppose that's the kind of context we're kind of talking about today.
And talking about living in the here and now, Tommy, I suppose not many of us take that a moment to take a step back and view the last decade, and when you say it like that, my God, it's eventful to say the least.
Absolutely. And if you take the decade before that, sure, we had the financial crisis. Before that we had the dot-com bubble and all that kind of stuff. So there's always something going to happen, and I suppose really it's just to kind of to take account of that and not panic.
Okay, and to help people, you have 10 evidence-based or backed points that they should keep in their mind before doing anything drastic to their pension or investment portfolio. So take us through those, Tom.
Yeah, and even though we haven't really had a correction yet, due to what's happening in the Middle East, there's a lot of volatility around there and that kind of stuff. So I suppose market corrections are normal and frequent. Basically, market corrections generally happen once every 2 years. A market correction is where it's a decline of 10% or more, so and they are normal. Since 1928, we've had 27 bear markets. They're declines of 20% or more in the markets, you know what I mean? So again, that means we've had a lot more bull markets, which are increases in prices rather than decreases in prices, so they're normal and frequent basically. That's number one. Number two, stocks have delivered positive returns the vast majority of the time. So 78% of the time in the last 100 years, markets have been in positive territory. Now that means that 22% of the time they haven't been. So you have to, 1/5 roughly of the time markets will go down, so 1 every 5 years you're going to have a bad year, and that could be a little bit more frequent depending on what's happening around the world. But the average annual return on the S&P 500, which is the American stock market, since 1926 has been over 10%. So again, if you did nothing, only leave your money in the S&P for the last 100 years, you would have had a return of over 10% per annum. But that again doesn't take into account all the bad days you would have had to endure as well. So you do have to endure those that market volatility, as we said. Okay,
and you were touching on the point about the frequency of bull markets compared to bear markets.
Yeah, and I suppose the bear markets are relatively shorter than bull markets in general. So again, bear markets, again, where you have a correction of 20% or more, the average length of time they have lasted for is about 9.6 months or 289 days to be very specific, whereas bull markets last around 988 days, which is, almost 2 3/4 years. So basically markets go up far longer than they go down. So, and that, if you look at bull markets have averaged around 112% gains, while bear markets have average losses of around 35%. Again, and that's in the last 100 years. So again, the math strongly favours those who endure the downturns rather than flee them.
And they're the ones who probably keep in mind that even in the dark times, the markets always bounce back.
They will always recover, and they always have every single time. And I suppose the recent one really is their COVID-19 crash in 2020, which saw the S&P 500 fall over 33% in just 33 trading days. So it was a massive decline. However, it was fully recovered within about 4 months. So again, if you had 100 grand invested in the S&P, was down to 67,000 at its lowest point, but within 4 months it had fully recovered.
And that's in a once-in-a-century pandemic.
Absolutely, yeah, absolutely. And even if you go back to, we were talking it off here in relation to the likes of the financial crash in 2008, 2009, they had all kind of fully recovered by the markets had fully recovered by about 2012. We weren't even bailed out by the IMF at that stage.
Yeah, that's a very, very good point. What else should people keep in mind?
Yeah, missing the best days devastates long-term returns. Again, 7 of the 10 best days in the last 20 years occurred within 2 weeks of the 10 worst days. What does that mean? Basically, when you have a really, really bad day, you can probably expect a really, really good day very shortly afterwards. So, if you were to miss those 10 days, it absolutely devastates your returns. So we'll say if you had invested in the S&P for the last 20 years, we'll say between 2004 2025, €10,000 would have returned about €71,000 over that time period. If you had missed the best 10 days, that €10,000 would only have returned 32,000. So trying to time the market, and we'll get onto it later, but trying to time the market is futile.
And I guess whatever misery or heartache people might experience during the bad days, that will be compounded if you get out of the game pronto, and then the best days come soon after you leave, and that will make you feel even worse.
Oh, absolutely. And I've come across a lot of people, and again, we'll come on to later on, that we'll say back in 2008, 2009, their investment or their pension went down, they panicked, they moved it into cash and did nothing for maybe 7 or 8 years, and they missed all the growth. You know what I mean?
Yeah.
That cost them an absolute fortune by actually that panic and not getting advice, really,
Why don't people listen to you more? That's what really what we need to say here.
That's what I keep saying to my wife.
Stay invested in the Tommy Corbett market to Mrs. Corbett for long term. What else should people be aware of?
Yeah, panic selling locks in losses permanently. So again, if you've 10,000 invested in, there's a 10% correction and it goes down to 9,000 and you come out of it, you've actually compounded the loss then by doing that. So basically temporary losses, only become real if you sell in a downturn. So basically don't panic.
Okay, why is Euro cost averaging important in relation to investments or pensions?
Yeah, so Euro cost averaging, what that basically means, it means investing on a regular basis. So for instance, if you're investing €100 a month today and markets go down, it means that you're buying in cheaper so that when the bounce comes you're going to get it, and it brings down the volatility in the long term. Again, it's not for everyone, but again, some people may be a little bit apprehensive in relation to about investing in lump sum. So most companies now will allow you to actually invest over maybe a 6 or 12 month period, that if you feel that maybe there's a little bit too much volatility there for yourself at the moment, that you can basically hit the market a number of times over the next 6 to 12 months.
Okay. And you were talking there about people who panic and move to cash and they regret it when the best days come. But what other negative consequences could there be from moving to cash? Yeah,
well, over time, inflation erodes the purchasing power of your savings. So basically, if you have money in cash and if inflation is at 3% and you're getting zero, interest rate, basically the power that your money has, the purchasing power that your money has been eroded over time. And yes, cash is very important for as a short-term vehicle, an emergency fund, as a buffer. But anything that you're not going to use in the next 5 to 10 years or more, you need to be investing, and you need to be able to, you need to be willing to take that little bit of volatility in order to make a return.
Okay, timing the market. I'm sure there are plenty of people who think they have it sussed, but they don't.
Yeah, and again, we said this earlier, timing the market is basically impossible. Again, what did we say? 7 of the 10 best days occur within 2 weeks of the worst days. So waiting for the perfect moment to sell or reinvest is never works. And also, by the time you feel confident enough to reinvest, you've probably missed the bounce. So basically timing the market. No one knows what's going to happen. I don't know what's going to happen next week, not to mind next year. So basically trying to time that market is virtually impossible.
Even though Tommy doesn't know what's going to happen next week, never mind next year, planning and getting advice from a gentleman such as Tommy is still a good route to go down, isn't that right?
Absolutely. Well, the one thing I always say, it's very easy to give advice, and it's very easy meet clients when market's going up and their investment has gone up 10% in the last year and they're all happy. It's when the opposite happens and they're suffering losses and investments are going down. That's really when you need to kind of hold their hand and I suppose offer a little bit of reassurance. And that's why I always say get advice, make sure that you have a diversified portfolio, that you're not locked into one kind of an asset class, and rebalance periodically. What does that mean? Maybe as you get closer to retirement, maybe as you get closer to needing funds, that you might switch a little bit out of more aggressive, I suppose, investment portfolio into probably a defensive strategy, that kind of thing. But I would say seek professional advice at every corner.
Okay, what other advice do you want to give to people?
Nothing really, just I suppose in turbulent times, sit back and relax, let the markets do their thing, and if you have any questions, don't be afraid to pick up the phone to your local advisor, and if you have any questions, you can always give us a call as well.
Okay, speaking of questions, we'll finish with a few of those. If I'm getting close to retirement, should I be reviewing my pension and de-risking?
Well, first of all, you should be reviewing your pension. You should be doing that probably once a year. Should you be de-risking? That's a very interesting question, because it really depends on what you're going to be doing after retirement. So most people will probably be going back into the markets post-retirement. So should you be actually coming out, there's an opportunity cost by coming out as well, but maybe you might de-risk a little bit. But again, it depends on your, I suppose, appetite for volatility and risk and that kind of thing. So again, I would say seek advice.
We know you talked about how much has happened in the last decade. If we boil that down to 2026 so far, there's been a hell of a lot happening in less than 3 months, and someone might be wondering, is now a good time or a bad time to invest, given what's happening geopolitically and the fuel markets and so on?
It's like to invest basically when you have money that you won't need for the next 5 to 10 years, and don't try and time the market. We've talked about it already. Even with all the volatility that's there at the moment, markets are still just about even or up year to date. Yeah. So is it a good time to invest? I don't know, as I said, what's going to happen next week or next month, so you can't predict that. It's a good time to invest if you don't need that money for the next 5 to 10 years.
Okay, and we're talking about fuel there. Why does the price of oil and gas have an effect on the markets?
Yeah, I suppose even though we're not as reliant on fossil fuels like oil and gas as we were back in the 1970s, I suppose it still fuels our economy in relation to the drives industry and that kind of thing. So basically, when oil goes up in price, it has a knock-on effect to food prices, to energy prices, etc. So basically, when energy prices and fuel prices and all that kind of stuff feeds into the economy, then we've less money in our pocket. If we've less money in our pocket, basically we've less money to spend, which has a knock-on effect then onto basically the companies and the markets that we invest in.
Okay, a real domino effect there. Tommy, thank you very much.
Thanks, Alan.
For joining us as always.